Building a financial legacy is a dream that many people aspire to achieve. It involves creating long-term financial security for yourself and your family and leaving a lasting impact on future generations. However, building a financial legacy requires careful planning, discipline, and a commitment to making sound financial decisions. In this video, we will explore some key strategies for building a financial legacy that can help you achieve your goals and leave a lasting impact. Hello everyone, welcome to Money Mindfuck. If you're new here, kindly hit the subscribe button and turn on the notification bell to get more videos like this. Let's get started without further ado. Create a plan. The first step in building a financial legacy is to create a plan. Start by setting clear goals and developing a financial plan that aligns with your long-term objectives. Consider factors such as your income, expenses, debts, and assets, as well as your risk tolerance and investment preferences. A financial plan can help you stay on track and make informed decisions about your finances. When creating a financial plan, it is important to consider both short-term and long-term goals. Short-term goals might include paying off debt or building an emergency fund, while long-term goals might include saving for retirement or funding your children's education. By setting clear goals and developing a plan to achieve them, you can build a solid foundation for your financial legacy. Invest wisely. Investing is one of the most important strategies for building a financial legacy. It is a way to grow your wealth over time and generate income for the future. However, investing also involves risks, and it is important to approach it carefully and with a long-term perspective. There are many different investment options available, such as stocks, bonds, real estate, and businesses. Each investment has its risks and potential rewards, and it is important to do your research and seek professional advice before investing. Diversification is also an important strategy for reducing risk in your investment portfolio. By investing in a variety of assets, you can spread your risk and reduce the impact of any one investment on your overall portfolio. Diversification can help you achieve more consistent returns over time and protect your wealth from market volatility. Save and budget. Building a financial legacy also involves living within your means and saving money for the future. Creating a budget is an important first step in managing your finances and making sure that you are living within your means. A budget can help you track your income and expenses and identify areas where you can cut back on spending. Saving money is also an important part of building a financial legacy. You should aim to save a portion of your income each month and consider automatic savings plans or other strategies that can help you save consistently. By saving money over time, you can build a financial cushion and generate wealth for the future. Minimize debt. Debt can also be a major impediment to building wealth over time. High-interest debt, such as credit card debt or personal loans, can be particularly damaging to your finances. To build a financial legacy, it is important to minimize debt and pay off any high-interest debts as quickly as possible. There are several strategies for paying off debt, such as the debt snowball or debt avalanche method. The debt snowball method involves paying off your smallest debts first, while the debt avalanche method involves paying off your highest interest debts first. Choose a method that works for you and stick to it. Protect your assets. Protecting your assets is another important part of building a financial legacy. There are several ways to protect your assets, such as purchasing insurance or setting up trusts. Insurance can help protect you from unexpected events, such as illness or injury. while trusts can help protect your assets from creditors or other legal claims. It is also important to plan for the distribution of your assets after your death. Estate planning involves creating a will or trust that outlines how your assets will be distributed and who will be responsible for managing them. By planning, you can ensure that your assets are distributed according to your wishes and minimize the impact of taxes and other costs. In addition, it is important to have an emergency fund to protect against unexpected events, such as job loss or medical emergencies. An emergency fund should contain at least 3 to 6 months' worth of living expenses and should be kept in a liquid, low-risk account. Teach financial literacy to future generations. Building a financial legacy is not just about securing your financial future, but also about passing on financial literacy to future generations. By teaching your children and grandchildren about personal finance, you can help them develop the skills and knowledge they need to manage their finances and build their financial legacies. Start by setting a good example. Show your children and grandchildren how you manage your finances and explain the reasoning behind your decisions. Encourage them to ask questions and involve them in age-appropriate financial decisions, such as setting up a savings account or making a budget. There are also many resources available to help teach financial literacy to children and young adults, such as books, games, and online resources. Consider using these resources to supplement your teachings and help reinforce important financial concepts. Planning for when you die is not something most people like to do, even if they know they should implement an estate plan. Learn about 8 tips to make sure your financial legacy reaches the right people. Number 1. Create trust now. One of the main benefits of establishing trust is that you can avoid what can be an expensive probate process. Your assets, including real estate, vehicles, and bank accounts, go directly to those you have listed as beneficiaries. Unlike a will that only takes effect after you die, a trust begins as soon as you sign it. This helps you ensure good financial decisions even if you become temporarily disabled. Additionally, when you opt for a will, the costs to your beneficiaries can be anywhere from 5% to 15% of total assets. However, a trust document minimizes these costs so that your heirs receive more of your estate. Number 2. Donate your assets while you are still alive. When you give money or other assets to your beneficiaries each year while you're alive, you ensure they get the amount you intended without the tax burden on your estate or them. The Internal Revenue Service, IRS, allows a lifetime tax exemption on gifts and property. For 2019, an individual's combined lifetime exemption from federal gift or inheritance taxes equals $11.4 million. If you're married, the joint exemption is $22.8 million. U.S. citizens also have an unlimited exemption for a property they inherit from a spouse. You can use all or part of this gift and estate tax exemption during your lifetime. Your heirs can use any remaining portion to reduce or eliminate estate taxes. Number 3. Convert traditional retirement accounts to Roth accounts. You can get numerous benefits by converting these accounts to Roth accounts. First, Roth accounts are not subject to the minimum withdrawal rules that apply to regular IRAs. Instead of starting to empty those regular accounts when you turn 70 and a half, you can leave the money in your Roth account. Second, while you will have to pay federal income tax when you convert the account, it won't be close to the amount your beneficiaries would have to pay in taxes. As long as the rules remain the same, this is a good strategy to minimize the tax burden on your loved ones. Number 4. Use life insurance benefits. Proceeds from a life insurance policy can offset losses of taxable assets to your beneficiaries that arise from income and estate tax obligations. Tax-free life insurance proceeds can be used to pay the tax burden or offset assets lost in estate taxes. Number 5. Use the temporary increase in generation skipping transfer tax exemptions. Currently, the amount of the generation skipping transfer tax (GSTT) exemption that affects transfers to grandchildren will increase to $11.4 million per person. If the transfer involves a married couple, the amount is $22.8 million. This amount will decrease starting in 2026. Now is the time to take advantage of this increase to help your family avoid taxes later. Number 6. Explore family limited partnerships. Although it requires very careful planning, it is possible to create a family business entity to minimize transfer taxes for those who receive your assets. Keep in mind that the IRS has challenged these types of partnerships in court many times to prevent tax evasion. However, given the right circumstances, a tax and estate attorney can help you form this partnership and properly leverage those benefits to withstand any legal challenge. One strategy that has worked before, for example, has been to keep family limited partnership assets separate from personal assets and create the partnership in good health. Number 7. Follow the UTMA for transfers to minors in the family. The Uniform Transfers to Minors Act, UTMA, focuses on your minor children. Set up as a trust, this legal framework can address guardianship and how to handle assets that minor children inherit upon their death. You can select someone, known as a custodian, to manage the assets left to your child or children. This arrangement generally ends when the child reaches the age of 18 to 21, although that age may be lower or higher depending on the state. By establishing this trust, you can transfer property and other assets to minors. Number 8. Plan charitable transfers to reduce general estate taxes. Since estate taxes consider the total amount of assets in your estate, it makes sense to find ways to reduce that overall taxable amount. One way to accomplish this is to donate taxable assets to charities that you designate in your trust. The rest of the assets will be valued at a much lower amount to help minimize what is taxed. That way, you can maximize the amount you have left for your beneficiaries. Number 9. Seek professional advice. Before moving forward with any estate planning action, contact experts such as a financial advisor, estate planning attorney, and tax professional. These financial experts can help you by analyzing your unique situation and outlining an estate planning strategy that will maximize your financial legacy. Finally, remember that building a financial legacy is a long-term process and requires patience and persistence. There will be ups and downs along the way, but by staying focused on your goals and making informed decisions, you can achieve financial security for yourself and your family and leave a lasting impact on future generations. That's all for today, folks. Thank you for spending some time with us. If you found this video interesting, let us know what you think in the comment box. Make sure to hit the like button and notification bell, and subscribe to our channel to get access to more interesting videos from us. While you are here, kindly click on one of the other 2 videos you see on your screen. See you there!